Let's Get Down to Business is presented by Bravo, the marketing arm of Ash Brokerage Corporation, the practice enhancement company. All this week, it's our tribute to Life Insurance Awareness Month. And on today's show, tax advantaged income with life insurance. And with me today is consumer reporter Kassie Rohde. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Backroom Technician. Let's get down to business. Well, welcome to the show, Kassie.
Thank you.
All this week, you're hanging in there 4 straight days. Wow. Well, we're talking about life insurance for income. Every time I write about this out on the web, everybody goes, Steve, I thought this was for protection. But there's a lot of tax advantages to life insurance, and there's 2 types of tax issues. One's called a modified endowment contract. The other one's called a non-modified endowment contract. Not very cool on their labeling. But let's get into it because this is really a lot of things that we want to talk about here.
What is a MEC contract?
An MEC contract, and some people call it MEC, some people call it modified endowment contract. That contract never existed until 6/21/88. In 1988, the service saw that we were selling single premium whole life and single premium universal life. The distance or the net amount at risk was so small that these contracts were so profitable that you could take money out of these contracts absolutely tax-free. Well, that didn't last long because we got out into the publishing and writing articles about how cool this was and how it was great to traverse and kind of escape taxation, and the service came down hard and rewrote the regulations, and any contract dated 6/21/88 and after, which, by the way, just for a heads up, I haven't seen any out of the street for a long time because that date's so far back. But starting forward, any single deposit is automatically a modified endowment contract. And if you take any money out, all the gain in the contract is taxable at ordinary income tax rates first. And so think about it. There are reasons that you'd want to do this. So when I talk about a modified endowment contract, one of the reasons I like is it still accumulates tax deferred. So as long as it's accumulating, I have no problem with that. And remember, you could be using it for death benefit, or in my case, for this segment, we're talking about income. I've noticed that many advisors will purchase modified endowment contracts and suppress the death benefit lower than they can according to the TAMRA regs. And the reason that they like to do that is because they can contain the cost and make whatever inside earning crediting method to really enhance it. For example, it could be interest rate. It could be index driven. It could be whole life using dividends. So there's a lot of ways to play in this regard, and using a modified endowment contract can really help.
All right, well, what is a single premium life insurance?
Well, we talked about this a couple days ago, but single premium is now a MEC. Anything written after, if you do a single deposit into a life insurance contract, it's going to be a modified endowment contract. Could you actually make it a non-modified? You could, but you'd be buying so much death benefit it wouldn't be worth it, and more than likely the contract would lapse. It just doesn't have the staying power under that kind of cost of insurance.
Well, are these MEC contracts just for the death benefit?
Well, remember, originally all life insurance is for death benefit. It's to indemnify and to protect. But a lot of clever and I would call creative advisors are using single premium as kind of an annuity alternative that has a death benefit. So if I suppress the death benefit low enough, if I contain my costs, whatever my crediting method is, whether it's dividends, interest, or index in those 3 examples, I might be able to compete heavily with a good annuity contract. And the best part about that is I can transfer that contract to the next generation or my beneficiaries, because the death benefit generally will go tax-free.
Well, would you ever want one of these contracts for supplemental income?
Here's the deal. If I knew I was in the lowest tax bracket at retirement, remember, I don't know that yet, but if I was, I sometimes have to look at, should I do a modified endowment contract, which I know is going to be taxable at the gain when I take the money out, or should I create a non-modified endowment contract? I don't know. First thing I want to look at is, what is the taxable event? And if my taxes are low, I may not want to have to worry about loan provisions of a non-MEC. I may want to go ahead and even annuitize it for life. Keep in mind that some of the annuitization rates on life insurance are much more benevolent than they are on single premium immediate annuities. So to me, that's something I need to look at. I'm not saying I'd do it, but I definitely want to look at it, because to me, the difference between paying taxes, if it's very low, I might want to be able to do a modified endowment contract, and that means I'm suppressing the death benefit even lower. So that's just some of the idea. When I'm looking at this is another one of our publications from Backroom Technician. And what it does is it explains the 7-pay test. Everybody always asks me, Steve, what's the guideline annual? What's the guideline single? What's the 7-pay test? To me, this maps it out in an easy to understand format and talks about the ordinary income taxation on modified endowment contracts. Keep in mind that these are, if you have any gain and you have any distributions, it will be at ordinary income tax. And remember, if that money comes out during retirement, that's also brought into the provisional income test for Social Security. That means that your Social Security could be taxed because of this or any other contract, including, by the way, your retirement income. You just want to be careful because all those income revenue sources are computed inside the provisional income test for Social Security to find out whether your Social Security benefits are taxed or not. So just keep in mind, this is just one of those examples. Now, the reason I like this, and again, if you say, Steve, I really like to have this, if you just order it at steve.savant@ashbrokers.com, I'll just send it to you because to me, it's a really good piece and helps explain in your head as well as explain it to your client in an easy to understand format. When we come back from the break, we're going to talk about the type of life insurance product that you can use with your client, and that is about income. And don't forget, you can request all the show's documents and use sample examples from Backroom Technician at ashbrokers.com. And remember, you can sign up for your own 30-day free trial offer from Backroom Technician. Just go out to their site, www.brtnow.com/trialsignup.aspx. We'll be right back after the break.
Take a close look at your hard-earned dollar. How do you think your money's doing? Are you keeping an eye on it? Is it protected from taxes, inflation, and market risk? Over time, those Washingtons could become Franklins. With tax-advantaged indexed universal life from one of the largest distributors of indexed universal life, Ash Brokerage.
Well, welcome back. I'm Steve Savant with Kassie Rohde. And remember, you can watch all our episodes of Let's Get Down to Business, including my weekly consumer show, Steve Savant's Money, the name of the game, right at ashbrokerage.com. Just click on the show logo at the homepage. And just a heads up, before moving forward with anything that you hear on our show, always consult your tax advisor or legal counsel, as well as your broker-dealer compliance department. Well, let's get down to business. We're talking about the types of life insurance products that you can use for income. And when you're using cash value, remember there's only so many restricted. There's only really basically 2 or 3 here that you can use. One of them is participating whole life. Another one is current assumption UL, universal life, and indexing. So those are the products. Let's talk about some of the questions I get from consumers on this issue.
Okay. Well, is life insurance a good supplemental retirement plan?
Well, to me, I love life insurance as a supplemental retirement plan. Sometimes, and I hate to break ranks here, but sometimes I like it as the retirement program, depending upon the client's tax bracket and their propensity for regulation, like are they going to need this money before 59 and a half? Is the rules better to do a IRA, a Roth IRA? Is it better to take my retirement plan that my employer is offering? I have to look at a lot of things, but as a supplemental retirement program, it can be great. Listen to this. You can take a life insurance contract, and as we talked about in yesterday's show, you could suppress the death benefit, get it down as low as you possibly can, and still comply with the TAMRA regs so that it's a non-modified endowment contract. Now, think about it. I can store money into that, and when I take the money out, I could take withdrawals to basis and policy loans to gain as long as I keep the contract in force for the life of the insured, and that money comes out tax-free. Now, at the break, we talked about a MEC contract being part of the provisional income test for Social Security. This is the beauty of using a non-MEC because none of that income from withdrawals to basis and policy loans to gain all ever show up on your 1040. So if it doesn't show up on your 1040, it's not going to show up on your provisional income test for Social Security, which helps your Social Security not get taxed. Now, heads up, what did I say? It has to be kept in force for the life of the insured.
Well, is it deductible?
I wish. Yes, it's not deductible, and someday over the rainbow, maybe we'll talk the government into it, but don't hold your breath. Right now, supplemental life insurance for retirement is going to be strictly after taxes. You're not going to get a pre-tax deduction, I'm sorry to say.
Well, then what life insurance products should we use?
Well, remember, when I talk about life insurance products, it's product suitability and client suitability. Remember, I need you to do a personal profile on your finances. Everybody's different. Everybody's at different stages of their life, like you and I are.
Right.
So I have to figure out, what is my risk tolerance? I have to measure that. And we have a good battery of questions that are in Background Technician that we use to walk our clients through it. And after that, we determine kind of an assessment. Are you conservative? Are you moderate? Or are you kind of liberal and aggressive? We need to know that, because what we need to figure out is, what is your propensity for risk? So if I'm going to match up a product, I have to first say, I have to do due diligence on you as a person. What's your personal financial profile? What is your risk tolerance? And what is your timeline? Not only to retirement, but as we said in the first show Monday, what is your timeline expectation of your life all the way out? Is it 90? Is it 95? How long am I going to use this? All that is part of my equation.
Right. Well, how does it generate income?
Well, what it does is it accumulates tax deferred. And when we take the money out, you're going to have a couple choices depending upon the product that you use. If you use participating whole life and or current assumption universal life, those are both interest-driven or dividend-driven contracts. You're going to be wanting to withdraw to basis, but heads up, you can't withdraw to basis generally during the first 15 years of any of these contracts. It could actually cause the trigger to the force-out rule, which would actually be a taxable event. So we got to be very careful about when we want to take withdrawals to basis, which we do. So withdrawals to basis and then policy loans to gain. Now keep in mind that these loans have costs, so it's not like it's free. And those two areas of withdrawals, and now in indexing, when you take withdrawals and policy loans, indexing uses a thing called participating loans. They have two sets of rates, just like the other two. They have variable, they have fixed, they have also the kind of interest rates, whether is it going to be current company practice or is it guaranteed in the contract. I always want to look at those before I make my final decision, but policy loans are the reason why I can take policy loans of gain as long as I keep the contract in force for the life of the policy, and I can take all that money out free as long as I keep it in force.
Well, what about the policy loan charges?
Well, they're all over the board, I'm sorry to say. I wish it was something pretty general and standard, but there is no standardization. There are basically 5 different policy loan platforms. Zero net cost loans, which is the charging and crediting of the same rate, about 30 days to 60 days apart. Then there is wash loans, the charging and crediting of the same rate, but 365 days apart. Then there are spread loans, where there's a difference between what we charge and credit, so you could be paying 1.5% to 2% for the policy loan, which by the way doesn't sound that high, 1 or 2%. You could also be using direct recognition policy loans, which are exclusive to participating whole life. Those charges could be up there, in insurance language at least, anywhere between 3 and 350 basis points. And then participating loans on indexing. If your index actually outperforms the fixed rate or the variable rate of that loan, you would actually make money on loaning yourself your income for retirement. People kind of like that ability. Just remember, heads up. You need to look at the contracts of each one of these contracts, especially the index, if you're going to use participating, because a lot of people don't even use withdrawals to basis. I think that might be a problem in the end game. When you're using life insurance for supplemental income, you want to make sure you're using the right product. You want to make sure you're using the least amount of death benefit of the TAMRA regs so that you can actually enjoy this as retirement income. Well, that's our show for today. I want to remind you that you can read all my online insurance commentary, advisor blogs, and articles on Producer's Web, and my answers to consumer questions on all kinds of things on insurance products from Insurance Library, as well as watch all our on-demand video shows of this show at ashbrokerage.com. So don't forget, you can follow me on Twitter, Facebook, LinkedIn, or email me at steve.savant@ashbrokerage.com. And remember, you could be wiser as an Ash Brokerage advisor.